They told us we had to wait until 59 and a half to touch our retirement money without getting hammered by penalties.
But they were wrong. There's actually a bridge strategy that lets you walk away from your 9-to-5 years or even decades early.
Today, we're showing you exactly how to unlock your brokerage account tax-free before the government says you're allowed to. So let's get into it.
If you're like a lot of people, you're probably dreaming of a day when you can ditch that daily grind and start living life on your own terms.
But a huge part of achieving that dream often involves figuring out how to access your hard-earned money before the traditional retirement age of 59 and a half.
Today, we're going to dive deep into the world of early withdrawals from your brokerage accounts. We're going to talk about strategies, potential pitfalls, and how to make sure you're doing it smart and efficiently.
We know this can be a really confusing topic, and there's a lot of misinformation out there. So our goal today is to break it down, make it easy to understand, and give you the confidence to navigate your own early withdrawal journey and share how we withdraw our money now that we're in early retirement.
All right, so let's think about it. Why would someone want to withdraw from their brokerage account before 59 and a half? The most obvious answer is early retirement.
The concept of FIRE, or financial independence, retire early, has gained so much traction recently. People are building up significant nest eggs in taxable brokerage accounts, and then the question becomes, how do I actually use the money?
So many people focus on the accumulation of wealth, but the decumulation, or how you spend it, is actually just as important, if not more so, for long-term financial success.
We often hear about 401ks and IRAs and their age restrictions, but brokerage accounts are a little bit different, and that's where the opportunities lie for early access. So let's clarify what we mean by a brokerage account. These are typically taxable investment accounts.
And unlike a 401k or an IRA, which are tax-advantaged retirement accounts with specific rules and penalties for early withdrawals, a standard brokerage account doesn't have those same age restrictions.
That's a key distinction in that. With a brokerage account, you've already paid taxes on the money you contributed, unless it was from selling something that generated a gain, which is taxed.
And this means you can technically withdraw funds from that account whenever you want. The challenge, however, is understanding the tax implications of those withdrawals, specifically the capital gains or what happens when you sell something in your brokerage account.
So we're talking about money invested in stocks, bonds, ETFs, mutual funds, essentially anything you've purchased through a broker, like if you've had Fidelity, Charles Schwab, or even newer platforms like M1 Finance or Robinhood.
So this is good news. There's no 10% early withdrawal penalty from the IRS just taking money out of a standard brokerage account before 59 and a half.
But, and this is a big but, you still have to deal with capital gains taxes on the profits or any profits that you've made, and that's where the strategy lies.
Okay, and we've seen a lot of questions on our videos and comments about this, so I think this is a really good point to make and to explain how we do this and how everybody can do this from a brokerage account. So this is probably the most critical part of early withdrawals from a brokerage account, understanding the capital gains taxes and how those work.
When you sell an investment for more than you paid for it, that profit is called a capital gain. The tax rate you pay on that gain depends on how long you actually held that investment.
So there's two main types. Short-term capital gains. These are profits from investments you've held for a year or less. They're taxed at an ordinary income tax rate, so remember that. And then second, we have the long-term capital gains. These profits are from investments you've held for more than a year. And these rates are generally much lower than ordinary income taxes.
And this is where the magic happens for early retirees. For 2026, the long-term capital gains tax rates are incredibly favorable for lower income brackets. So as you can see, for single filers with taxable income up to $48,350 and married filing jointly up to $96,700, your long-term capital gains are taxed at 0%.
Can you believe that? 0%. I can't tell you how many times we've seen comments or people will say, yeah, but you pay taxes on those capital gains. I think what's going through their head, this is just my guess, is that they're looking at the income they're making today and they assume that it's going to be similar tax rates as that. And they're not considering whether it's a long-term capital gains or a short-term. So anyway, this is huge. This is a game changer. It means that you can sell appreciated assets, you can realize those gains and pay no federal income tax on them, provided that your total taxable income, which includes those capital gains, stays within that 0% bracket. So in the example that we just said, What would it have to be between
48,000 and 96, depending on if you're single or if you're married. But again, that's like, you have to make sure that you stay in that bracket. That's the magic.
I know, it's kind of funny. You can't make more than a certain amount. I hear my parents are retired as well, and they always talk about not making more than a certain amount for a lot of different reasons.
Yeah, so this is often referred to as tax gain harvesting, or living off the 0% capital gains bracket. It's a cornerstone strategy for many early retirees.
So remember, your taxable income includes your capital gains minus the standard deduction or itemized deductions. So you have even more room than just the bracket number suggests.
So let's quickly differentiate between selling to cover living expenses and merely rebalancing. When you sell an asset and then withdraw the cash, that's a withdrawal. If you sell one stock to buy another, it's a taxable event, but not necessarily a withdrawal of funds for living. So how do you actually implement this? Here are a few practical strategies. The first is the 0% capital gains bracket strategy.
So this is the one that we just talked about. In our early retirement years, when you likely have little to no taxable income from a job or from a 9 to 5, you strategically sell appreciated long-term assets to fill that 0% long-term capital gains bracket.
For example, if you're single and you need $40,000 a year and your standard deduction is around $15,750 for 2025, you could realize around $64,000 in long-term capital gains and still pay 0% federal tax.
And this means you're effectively withdrawing tax-free money from your brokerage account for your living expenses. It's a fantastic way to bridge that gap until you can access your tax advantage accounts when you turn 59 and a half and to start Social Security.
So the second strategy is tax loss harvesting. Sometimes things don't go up. If you have investments that have lost value, you can sell them to harvest those losses.
So tax losses can be used to offset capital gains dollar for dollar. If you have more losses than gains, you can actually carry over $3,000 from those losses to offset ordinary income each year. Any excess losses can be carried forward indefinitely.
This is a great way to reduce your overall taxable income and make your withdrawals even more tax efficient. It's about taking advantage of both the ups and the downs of the market.
Okay, this brings us to the concept that sounds kind of fancy, but it's actually your best defense against a market crash right after you retire. It's called sequence of returns risk.
Basically, if the market drops 20% in your first year of early retirement and you're forced to sell stocks to pay rent, you're locking in those losses. It makes it incredibly hard for your portfolio to recover because you have fewer shares left to grow when the market inevitably bounces back.
So to avoid this, you can use a cash bridge. This is a pile of boring money. Think high yield savings accounts, money markets, or short-term CDs that isn't even in the stock market.
So we recommend keeping 1 to 3 years of your living expenses in this cash bridge.
Think of this as your financial shock absorber. If the market is up, you sell your stocks and you keep your cash bridge full. But if the market has a bad year, you stop selling stocks entirely. You leave them alone, you let them recover, and you bridge the gap by spending your cash instead.
It's all about the sleep at night factor. Knowing you have 3 years of cash sitting there means you don't have to check the ticker symbols every morning with a pit in your stomach, or watch that go up and down and either yell or scream or whatever happens.
Yeah, which we may know a thing or two about that. Now there's one hidden cost to early withdrawal that catches everyone off guard, and that's healthcare.
Since you're retiring before Medicare kicks in at 65, you're on the hook for your own insurance. This is where your brokerage account withdrawals can actually be a secret weapon for getting ACA subsidies.
So the government calculates your health insurance subsidy based on your taxable income, not actually how much money you have saved in the bank, which I've always thought was kind of crazy.
Yeah, no. If you're living off your brokerage account, remember that only the gains count as income, not the principal you originally put in. By keeping your income low on paper through the 0% capital gains strategy we mentioned earlier, you could qualify for massive subsidies that save you thousands a year in premiums.
So it's like a double win. You're paying 0% in taxes and you're getting a huge discount on your health insurance. That's pretty cool.
Before we wrap up, let's talk about a few mistakes we see people make when pulling from their brokerage accounts early.
So number one is forgetting about state taxes. Just because the feds might give you a 0% on capital gains doesn't mean that your state will. And every state is a little bit different, so check out your local laws.
Number 2 is the wash sale rule. If you're tax loss harvesting and sell a stock at a loss, you can't buy that same stock or something substantially identical back for 30 days. If you do, the IRS won't let you claim that loss.
And finally, don't forget about dividends. Even though you didn't sell a single share, the dividends your account produces count towards your taxable income. If you're close to the top of that 0% tax bracket that we talked about, those dividends could accidentally push you into that 15% zone.
So we covered a lot today, from understanding capital gains to building a cash bridge and hacking your healthcare costs.
The biggest takeaway is that 59.5 is just a number. If you've been diligent about investing in your taxable brokerage account, you have the keys to the exit door much sooner than you think.
It's about being strategic, not just about having the money. If you can master the tax brackets and the timing, you can truly live the life you want on your own terms.
If you guys found this helpful, please do us a huge favor. Smash that like button, subscribe to our channel, and that'll help us get this video out there to people that are dreaming about financial independence and early retirement.
And if you want to see exactly how we're calculating our own bridge numbers or how it can help you, we've put together a free early retirement checklist in the description below.
So thank you guys so much for watching, for subscribing, for commenting, for all of your feedback. We'll see you in the next one. Thanks, guys.
Sully's in here. Smile.